Most Americans retire with less than $50,000 saved. One decision separates those two futures. It costs exactly $100 a month. Let's find out. Here's something the financial industry will never put on a billboard. The Federal Reserve surveyed American households, specifically the ones between 55 and 64, the people staring retirement right in the face. Their median retirement savings? $134,000? That sounds like a number until you do the math. Most financial planners say you need roughly 10 times your annual salary by the time you retire. For the average American household pulling in around $80,000 a year, that means you need somewhere close to $800,000. And the median family in their late 50s is sitting on $134,000. That's not a gap. That's a canyon. Now here's the part I want you to sit with for a second. That canyon doesn't exist because those people were lazy, or reckless, or bad with money. Most of them worked hard their entire lives. They paid their bills, they raised families, they did everything they were supposed to do. What nobody told them, clearly, plainly, at the kitchen table when it would have mattered, is that there is a mechanism running inside the US financial markets right now that will quietly grow your money while you sleep. It doesn't care what your job title is. It doesn't care what zip code you live in. It doesn't care whether the market feels good or terrifying this week. It just works, slowly, invisibly, and then one day you look at the number and you can't quite believe it's real. That mechanism is compound growth. And today we're going to take the whole thing apart and look at exactly how it works, including the parts most people skip right past. We're going to look at why starting small isn't just okay, it's actually the whole strategy. Why waiting for the right time to invest is a game you simply cannot win. And why the single most powerful financial move available to you right now has nothing to do with picking the right stock. So let's open this thing up. Before we talk about compound growth, I need to talk about something most investing videos skip. Because it isn't glamorous, it won't make a great thumbnail, and honestly, it sounds a little boring. But if you miss this step, everything else we discussed today could blow up in your face. You need an emergency fund before you invest a single dollar. I know, riveting content. Bear with me. Here's why this matters in a real and practical way. Say you start putting $200 a month into a Roth IRA. 3 years later, your transmission goes out and you need $3,000 that isn't sitting in a savings account. Where does that money come from? It comes out of your investments, probably at the worst possible moment, possibly at a loss, possibly with tax consequences attached. The Federal Reserve's 2024 report on the economic well-being of U.S. households found that 37% of American adults would struggle to cover a $400 emergency expense without borrowing money or selling something. Nearly 4 out of 10 people. Which means for nearly 4 out of 10 people, investing without a safety net isn't a wealth-building strategy. It's a trap. The standard guidance is 3 to 6 months of living expenses in a high-yield savings account. Somewhere you can actually reach it, not invested, not tied up, just sitting there being boring and liquid and perfect. Once that floor is in place, your investment contributions become untouchable. And that changes everything about how compound growth works for you. Without the emergency fund, your investment account is a piggy bank. With it, it becomes a vault. Now here's the part nobody tells you. You invest $100 a month into a low-cost S&P 500 index fund, something like a Vanguard or Fidelity total market fund with an expense ratio close to 0. The S&P 500 has averaged roughly 10% annual returns over the past century, accounting for dividends. Not every year. Some years it runs up 25%, some years it drops 30%. But zoom out far enough and the long-run average lands right around 10%. Year 1? You've put in $1,200. Your account shows maybe $1,264. You're not retiring on that. But here's where people fundamentally misread what's actually happening. In the early years, almost every dollar in that account is a dollar you put there. Your contributions are doing the heavy lifting. The market's contribution is minimal because the base is small. It's like trying to heat a house with a single candle. The candle is working. There just isn't enough fire yet. After 10 years, you've contributed $12,000 of your own money. Your account balance at 10% average annual returns, about $20,655. So $8,655 of that is growth you never worked for. The market put in more than $700 a month just by showing up. Stay with me, because this next number changes everything. Stretch that out to 20 years. Your total contributions, $24,000. Your balance, roughly $76,570. You contributed less than a third of that number. The other $52,000 plus came from compound returns. Your returns earning returns, feeding on themselves like a very polite and financially responsible snowball rolling downhill. And at 30 years, you've put in $36,000 of your own money. Your balance sits at approximately $226,049. You contributed 16 cents of every dollar in that account. The remaining 84 cents showed up on its own. That is compound interest, not a metaphor, not a motivational poster. That is the actual math. And the reason it works that way is because your returns stop being calculated on what you put in. They start being calculated on everything that came before, including the interest on the interest on the interest on the interest. Albert Einstein may or may not have called it the eighth wonder of the world. The IRS definitely noticed it was working. Here's the part where the numbers get genuinely uncomfortable to sit on. Most people's earning power in their 20s is not their earning power in their 40s. You start somewhere. You get better at things. You get promoted. Life gets more expensive, and, hopefully, your paycheck reflects that. The wealth-building implication of that trajectory is dramatic, but only if you actually move your investments up with your income. Let's build a real scenario using real US dollar figures. In your 20s, you start with $100 a month going into a Roth IRA, building the habit, keeping it small and consistent. In your 30s, after some career progress, you step it up to $400 a month, splitting between a 401k, especially if your employer matches, because that is literally free money, and a Roth IRA. By your 40s, you're investing $800 a month. In your 50s, the IRS actually gives you something, catch-up contributions, which allow Americans over 50 to put even more into their retirement accounts. Let's say you hit $1,200 a month. At 10% average annual return across 40 years, that escalating strategy builds a portfolio worth approximately $1.4 million. Across those 4 decades, your out-of-pocket total, roughly $228,000. The market contributed over $1 million to your account. Because you let it compound, that's the whole trade. You provide the consistency. Time and mathematics provide the rest. One distinction worth making here: a Roth IRA means you contribute after-tax dollars, and the growth comes out completely tax-free in retirement. A traditional 401k means your contributions reduce your taxable income now, but you pay taxes when you withdraw later. Which one makes more sense for you depends on your current tax bracket versus where you expect to land in retirement, and a fee-only financial advisor can walk you through that in about 20 minutes. But the vehicle matters less than the habit. Start. Adjust as you grow. Don't wait for perfect. Here's a scenario that plays out approximately 10 million times a year in America. Person opens a brokerage account. Markets look a little shaky. An economist on CNBC uses the word turbulence. Person closes the laptop, decides to wait and see. 6 months go by. Market is up 12%. Person has missed it. Person opens the laptop again, decides to wait for a pullback. Pullback comes. Person panics. Person waits. Market recovers, person still hasn't bought anything. This is called market timing, and it doesn't work. Not because people are bad at math, but because the human brain is simply not designed for it. We are wired to avoid loss harder than we seek gain. The psychological pain of watching $10,000 become $7,000 is roughly twice as intense as the pleasure of watching $10,000 become $13,000. That's not weakness. That's neuroscience. And it kills portfolios. Now here's where most people stop watching and start losing money. A JP Morgan study of the S&P 500 from 2003 to 2023 found that if you missed just the 10 best trading days over those 20 years, your annualized return dropped from about 9.8% to 5.6%. Miss the best 20 days? You're looking at 2%. Miss the best 30 days? You actually lost money over a 20-year period that was overall one of the greatest wealth-building windows in American history. Those 10 best days? 6 of them happened within 2 weeks of the 10 worst days, meaning the investors who cashed out during the crash, the very people trying to protect themselves, were the exact ones who missed the bounce. The ones who stayed, even during the ugly months, got paid. The 2008 financial crisis, the COVID crash of March 2020, the 2022 rate hike drawdown. Every single one of those events looked catastrophic from inside it. Every single one recovered. The S&P 500 today is higher than it has ever been. That's not because the US economy is invincible, it's because the index contains the most adaptable companies in the world. And over time, human productivity and corporate earnings have one direction: up. With detours, painful, sometimes terrifying detours, but up. The investor who stayed through 2008 and didn't sell made back every dollar, and then some within 4 years. The investor who panic sold at the bottom locked in a loss that no amount of hindsight could unring. Downturns are not emergencies. They are the price of admission for the long-term gains. And once you genuinely understand compound interest, once you've actually done the math, a dip starts to look less like a disaster and more like a sale. Dollar cost averaging is the strategy that takes emotion out of the equation entirely. You invest a fixed dollar amount on a fixed schedule, say $200 on the first of every month, regardless of what the market is doing. When prices are high, your $200 buys fewer shares. When prices are low, your $200 buys more. Over time, you naturally accumulate more shares during downturns and fewer during peaks. The volatility actually works in your favor, but only if you keep buying. The investor who sat on the sidelines waiting for clarity never gets clarity. The news is always bad about something. That has always been true, probably always will be. So let's bring this back to where we started. The median American near retirement has $134,000 saved when they need closer to $800,000. That isn't a math problem. They were never shown the math. Nobody handed them this conversation at the kitchen table when they were 25, and it would have made all the difference in the world. What we've covered today isn't complicated. You build a financial floor, a 3 to 6 month emergency fund, so your investments can do their job undisturbed. You start with whatever you can actually afford, even if that's $50 a month, because the habit is the whole point and time is the engine. You escalate your contributions as your income grows, using tax-advantaged accounts like the Roth IRA and your employer's 401k, especially if there's a match, because that is a 50% to 100% instant return that no stock on earth can compete with. You stay invested through the dips, because the dips are temporary and the gains are permanent if you give them enough time. And you do not wait for the perfect moment. There is no perfect moment. The perfect moment was 10 years ago. The second best moment is the first of next month. Automatic contribution, set it and forget it. The machine is running right now. The question is whether your money is in it. I'm Warren Bucket, and that, folks, is how $100 a month quietly turns into something your grandchildren will still be talking about. You're welcome.